Hey everybody, welcome to this free edition of our Trader User Group Weekly Roundup. This is for the trading week ending August 25th, 2023. I'm Preston Brent. Thanks for tuning in. Very interesting week here. Let's just jump in and see where everybody's floating along here, see how the events for the week unfolded here. If we take a look at the U.S. markets, you can see it was kind of a mixed bag. Dow and Russell in the red just a little bit. Year to date, everybody's in the green, but the Dow and the Russell are bringing up the rear with NASDAQ leading the way higher. But again, mixed signals from the economy, and of course, we got a little bit of a mixed signal from monetary policy. And we got several retailers that reported Q2 results. We want to follow the consumer spending very closely. We did get University of Michigan's final reading of the August consumer sentiment. That came out on Friday. Fell a bit from July's nearly two-year high, basically on higher inflation expectations. We did see the continued health of the labor market, however. It confirmed by the weekly jobless claims report, it came in at about 320,000, lowest level in about 3 weeks. Although we did get the S&P Global Index of Manufacturing Activity, that fell a little bit more than expected in August. But the big event for the week, really, to be honest, was Friday's Jackson Hole, Wyoming speech by our head muckety-muck, Mr. Boom Powell, the Fed chair. He gave an indication of how he's interpreting these mixed signals in the market. And he noted that a little bit of a mixed delivery as well, actually. He noted that higher rates slowed growth, right? Everybody kind of knows that. Tightening bank lending standards, everybody knows that. He said that's kind of cooling the economy. Yet he said, on the other hand, the economic growth remained above its longer-term trend, and that the housing sector appeared to be picking up a little bit. And then he concluded his remarks by stating that we're navigating by the stars under cloudy skies. Oh my God. Well, that's comforting. Net, the markets interpreted his comments as hawkish, not as hawkish as last year's when the markets crashed, but still hawkish nonetheless. It moved down and then finished up a little bit in the green. Mixed bag, as I showed you, as you can see right there on the screen. Okay. PE ratio fell a little bit. Forward PE just slightly under 20, but let's call it 20. Still higher than I'd like to see. Dividend yield at 1.55 for the S&P. 10-year Treasury, wow, it's highest level since 2007. It actually hit an intraday level this week at 4.36. Hang on, wait just 1 second, guys. Hang on a second. Hang on. Sorry, guys. But anyway, Treasury's highest level since 2007, 4.36%. Close out the week essentially unchanged, 4.24, but still very high. The 10-year Treasury, as most of you should already know, is a primary security that banks follow for credit cards, mortgage lenders follow for mortgage interest rates. So it's closely watched, okay? You can see the best performer for the week. Technology, 1.48%, worse energy. Year to date, communication services still leading the way higher, utility still leading the way lower for the year. If we come over and take a look at Europe and just kind of see what they did, you're going to be able to see here that, excuse me, you're going to see mostly in the green across Europe. In fact, everybody in Europe was over in the green, although they've been having a really bad time of it. Their PMI compiled by S&P indicated that business activity across Eurozone is really down 3 months in a row. Now, that's not new news. That's been out there. So we're getting a little bit of a bounce here in the markets, but you can see the FTSE over in London, the UK, they're in the red year to date, okay? The Eurozone Composite Output Index kind of combines data from both services and manufacturing. Again, not new data, but this past week it fell to a 33-month low of 47 from 48.6. And the UK PMI composite also fell to 47.9. So anything below 50, as you know, is in contraction territory. So there's a higher odds that Europe is, if not in a recession already, will be in one very soon. Okay. And if we come over the Asian markets and look at Japan, well, the Nikkei was up for the week and up very healthy for the year, over 21%, right? Their composite PMI actually rose to 52.6 in August, just slightly from the prior month. And the interesting thing in Japan, their yield on their 10-year government bond rose up during the week, moved up as high as 68 basis points within the week. That's like the highest it's seen in a decade, right? And the value of the yen, meanwhile, has tumbled down to levels approaching those levels in the October 2022 lows. And back around that time, that prompted the Bank of Japan to step in and support their currency. So, members, we'll go through this a little bit more detail this Sunday evening, our weekly market watch, but there's some opportunities, I think, shaping up in the end. Meanwhile, the Chinese markets, as you can see, are in the red for the week. They're having a hard go of it. China actually moved into the red year to date this past week. Hang Seng flat for the week, but solidly in the red for the year. Chinese stocks are falling. Investors are growing more pessimistic about their country's outlook. I mean, you got disappointing economic data, signs of deflation, huge record youth unemployment, which China's now not publishing, but it's over 20%. And they got liquidity problems because they got debt-laden property sector, real estate. So they've got a lot of erosion of confidence in their economy. In addition to all of that, we're seeing a lot of offshore funds selling the equivalent of over almost 11 billion in mainland Chinese markets over the past 2 weeks from this prior Wednesday, moving money out of that economy. Just remember, if China gets very sick, it will bring down Europe. It's already slowing Europe down a lot in the exports out of Europe or imports into China, which are both down. Same with the exports of China, they are down as well. So these are some of the things that we got going on in the markets right now. I'm going to shift the focus. Let's go take a look at the charts real quick. And I'll show you how we're coming down and hitting my target levels that I posted here a while ago. And you'll see these target levels are hitting nicely. It's going to take a couple of seconds to come up on the screen for you. But you can see here, this yellow circle was near term. This blue circle is longer term out, but not by much. You can see where we've broken the 50 EMA. We came down and essentially off of the 2023 highs where we closed for the week. We're not down that much, only about just slightly under 5%, right? 4.76, give or take. About 220 S&P points off the highs that were made back on July 27th. So the month of August has been a down period for the markets, but it's not an ugly down period. It's just a recalibration down period, which is why I said we would want to buy the dip. Now, I don't know just yet if this down move is over or not. And when I say buy the dip, I don't mean run out Monday and start buying. If we put this on a weekly chart, you can see here that we've had 3 weeks in a row of down moves, and then this past week was the first weekly move higher. Okay. And you could see here that I think we may move a little bit lower. We may have a little bit of a bounce up into this little shaded zone here around 4,400. I don't know if we'll be able to get up there and hold that level before running back down again and hitting the 4,300 level, and then possibly even this next fib node at 4174. So if I take it back to the daily again, you'll see what I'm talking about here. Notice the 50 EMA has started to roll over just a little bit. The 200 EMA has still got an upward trajectory, but that's going to start to run flat. And notice the 50 EMA is well distanced north of the 200. So that tells me that we were a little bit overdone in that rally that we had in early summer. And now August, September, probably into October, we're going to have a very choppy time with neutral to slightly down moves. And you could see here for the week, we just one day it's up, the next day it's down. And we couldn't even go back up on Friday and take out Thursday's high. So we're kind of, I think the odds do favor a little bit more downside. Now, the 50 EMA is sitting right up above us, right around 44, 42, you know? So if we take that out and hold it, then we can move up into this little, let's say, resistance zone up here, coming up from the bottom up. So we'll see how this shapes itself out, all right? And of course, if we look at the Dow, which is one of the worst performers for the year, you can see it's blown through my original support point. We're well south of the 50 EMA, and we're just north. We're stuck between the 50 and the 200. Typically, what happens when the 50 is over the 200 and you break down below the 50 on any asset, right? Technology or technical indicators typically will show that the asset in question will move back up to the 50 EMA and test it. And if it fails, then the odds dramatically favor coming back down to the 200 EMA. If it moves up to the 50 EMA test and moves above it, tests it again and holds, then the odds favor it moving higher. So this is kind of where we're sitting right now. The near-term effect probably suggests a little bit of a drift higher on these indexes to test the 50 and then a possible rollover should it not regain the 50 EMA. Now, if we look at NASDAQ, you can see with NASDAQ, none of them have hit my target, right? And this is a daily chart. If I zoom in a little bit, let's zoom out like this. You can see my target was around 14,000 to 13,700, right? 14,200 to 13. Notice we're below the 50 EMA. And I know that NVIDIA's earnings helped jack up technology on Thursday and Friday, but they started to roll back over again on Thursday. And then Friday, we had a little bit of a bounce. But I do think the odds favor more downside, right? And NASDAQ is a little bit further off than the S&P. NASDAQ is down right now off the highs this year of around 6.5 to 6.7%, right? Over 1,000 points off the highs. So a little bit of a rally is in order and then another step down, I believe. And then, of course, if we look at the Russell, which is right behind the Dow as far as performance for the year, you can see the Russell came through my support points right here and is just sitting right on the 200 EMA. We went below it on Thursday, and then Friday we're attempting to regain it. We could not regain it. If we do not regain that 200 EMA, folks, we're going to probably come down and test the 2022 closing price, which would put us into the red for the year for the rut, 1777. Now it's at 1855, so you're talking a little over 80 points or so. 80 points. We'll see how that thing plays itself out. But again, I think any rally is going to be short-lived, at least through August into September. We may have a little bit of an extended rally, but I think it'll roll back over before we finish out the month of September. Okay. So that's a little bit about what I'm seeing here. And then, of course, if we come down and look at volatility, you can see the VIX closed at 1568. But it's over its 50 EMA, right? And you could see the 50 is below the 200, and there is no divergence here. So that suggests that the VIX is going to stay elevated into this yellow zone, which is over 14 to 20. But I don't think it's going to get much lower than this, nor do I think we're going to jack up here until we get a little bit more of a downside move in the equity market. And if we look at treasuries, well, like I said, the 10-year treasury hit its highest intraday level since 2007 this past week, coming in at 4.36%, all right? And now you can see the bond market, we hit a low back over here on the 22nd of August, and now we're trying to move up just a little bit. We actually took out the 2022 lows, right? And we made new 2023 lows in the bond market. And if we look at the 10-year treasury, right? You can see here, I'm sorry, not the Treasury, but the 10-year interest rates right up here. You can see here the intraday high, right? This right here, 434. Let me just see if that one was even higher. Yeah, it was. So this one hit that 436 level right there. That was on the 22nd of August. So we're taking these out. The support point underneath is going to be right around here for this 10-year, right around 4.09. Okay. But you could see this movement higher once the Feds have said we're going to stay higher for longer, right? So there is no divergence here, but up at these levels, I would not mind, and we'll go through this in a little bit more detail Sunday night for our evening session. You can see here the TLT tends to follow the bond market, right? And TBT follows the interest rate market. Interest rates are higher here. I think puts on TBT around these levels going out to December makes sense to me, right? Now, members, we'll talk more detail about this, but you could see there is no divergence in that higher move there. This suggests we're going to move up a little bit more and then roll. The odds of a Fed rate hike this September are only about 14.5%. All right. So that means about an 85% chance the rates are going to stay the same. And that'll put downward pressure on interest rates, upward pressure on the bond market, right? Playing the bond market right here to the upside makes a little bit of sense to me, at least running up to the 50 EMA. Members, again, we have a way of trading the bond futures market and options that works out very well. And I may review some of that with you this Sunday evening. Currency wise, well, the dollar is getting stronger. In times of global uncertainty, you can see the dollar is just moving up very strong. A little bit of a pullback and then a final move higher. We took out the 50, we took out the 200. So obviously, what does that mean for the euro? The euro is going to be weaker, right? And longer term, we want to be bullish the euro, but short term, you don't want to be in this thing. I think it's going to come down and actually could possibly even move into the red. If Europe falls into the recession, many believe they're already in a recession. Remember, they've had three um, months in a row where they've gotten reduced PMI. It's just not that good. So that's a little bit about where we're sitting here on the dollar and the euro. So right now, if they do get worse, you're going to see the euro continue to come down and the dollar stay strong. Okay. And then, of course, we come to gold. It's a no trade for me right now. It's nothing but chop. You could see this camelback movement here, and it's trying to get over the 200 EMA. It was down on Friday. It's just been moving down a pretty good little bit. So I wouldn't touch this until it elevates over the 50 EMA and it holds it, finds support, and then we see a little bit supported by volume of it moving higher. In fact, my near-term projection is actually to see gold come down here around 1850, right? And of course, if we look at silver, you can see silver, generally they kind of flow together. It's just very difficult to trade this. It's over the 50 EMA. It's a little bit stronger than gold, but I do believe that it's just right now, it's not a place to be. There are easier assets to trade than gold or silver. Copper goes where China goes. You can see here this regression channel. It's just moving down. We cannot hold the 50 or the 200. You could see we made it above both the 200 and the 50. The 200 is the yellow line. The 50 is a red line. We went over it one day, but we couldn't hold it the very next, and then we gave it all up on Friday. So the odds favor it coming back down to that center part of that regression channel. So you can just see how copper's coming down. So goes China. So goes copper. And China's having a hell of a time right now. Oil is projected to go higher. This is just more of a buy the dip opportunity here. You can see for 3 days in a row, it's hold the 50 EMA. It just regained the 200 EMA on Friday. So if it moves back above 80.51, and we're close, it's at 80.05, then I think it's going to make another run for the 2023 highs of 84, 89. So call it 85. So I could see that run happening. Nat gas, I've been all over this one. Selling puts underneath, you could see that tight regression channel. We're hitting the bottom of it, so putting another put on here would make some sense. Run up to the middle and then roll back over. It's starting to get at that level where it's getting a little bit further away from that 2 level, but we've been selling puts underneath here, or doing some other options trades in the nat gas market, and it's worked out really well for us. All right, everybody, that's kind of where we're sitting right now on this weekend for the week ending August 25th. We got about, what, 4 more days left of the month of August, and then we got a Labor Day weekend. I will not be doing my weekly roundup the following weekend as it's a holiday weekend here in the U.S. So everybody have a really great weekend. Members, I'll see you tomorrow night for our weekly market watch. Take care, folks. Ciao now.